Coming up on Business Incorporated. South African Reserve Bank Monetary Policy Committee announced 25 basis points repo rate increase. Ghanaian president, ministers slashed salaries by 30% to reduce government spending. Egyptian pound slides further after the Apex Bank hikes main interest rates. Hello, welcome to the program. I'm Ladi Williams. First off, let's take a look at what's happening in the markets. I'll begin with markets in Africa, where Nigeria's main index was positive at intraday, marginally up by 0.02%. South Africa's index jumped slightly by 0.08%. And Egypt's equities market closed on Thursday. However, its index was down by 0.3%. The Nairobi Stock Exchange ended Thursday's trading session in negative territory. Now to the Middle East, where major equities closed Thursday in the green. The Abu Dhabi and Dubai's index both traded positive, up by 0.07 and 0.54% at intraday, while within the region, Saudi Arabia closed marginally in the green on Thursday, up 0.03%, while the Qatari index gained 0.79% to close. All right, now let's head on to Europe, where U.S. President Joe Biden's visit to Brussels is the main news today. Joe Biden and the EU leaders have been discussing further sanctions on Russia as well as energy. Let's get an update from Chelsea Delaney right there in Berlin. Great to have you, Chelsea. So we have more details on the U.S. agreement to provide natural gas to Europe. How big is this deal?
Well, what's being discussed is an additional 15 billion cubic meters of liquefied natural gas coming from the U.S. to Europe in 2022. That may sound like a lot, but it actually is nowhere near enough to cover Russia's supply to the EU. In 2021, Russia exported 155 billion cubic meters of natural gas to the EU, so this U.S. deal would cover just about 10% of that. Of course, the EU is not only looking to the U.S. here, it's also been talking with Qatar, Norway, Azerbaijan, and many more countries about increasing natural gas supplies. But the International Energy Agency estimates that the EU will only be able to find about 30 billion cubic meters of gas from non-Russian sources to buy this year. So under that scenario, we can only reduce our Russian supply by about 20%. While that is really a huge shift when you're talking about energy supplies, it still is going to fall far short of the EU's pledge to reduce gas purchases from Russia by 2/3 this year. So it's going to need to increase also the use of other energy sources like biomethane or renewable hydrogen as well. There's going to have to be some sort of demand reduction using less of these fuels if the EU wants to follow through on this pledge to really cut its reliance on Russian gas.
And quite interesting, but give us a sense of how the markets are reacting to this.
Energy markets are very much volatile right now. Traders are on edge. They're trying to figure out how secure the EU's energy supply really is. So after the news of this deal for U.S. LNG broke, we did see EU wholesale gas prices decline. They were down by about 5% on Thursday. In general, traders don't see this as the end of the natural gas price rally. It's up about 500% this year. There's still far too much uncertainty about Russia's energy supply going forward. For now, Russian gas is flowing into the EU. The EU says they won't implement a Russian gas embargo because of how much they need it. But EU gas companies, EU politicians are increasingly worried about disruptions, especially after Russia made this demand this week that the EU pay for gas in rubles. The response from the EU to that has mostly been a resounding no, but it's unclear whether Putin will accept that they won't pay in rubles, that they continue to pay in euros, or if he'll cut off the taps of natural gas. So energy markets remain on edge, as do stock markets here in Europe. We've seen the DAX in Frankfurt, the broader pan benchmark, Euro stocks basically fluctuating every day, and they're ending the week essentially flat.
Well, all markets are on the edge right now. But meanwhile, German energy companies are warning of an imminent natural gas supply shortage. They're calling the government to activate its emergency plan. What do you think that plan would look like?
So this was from a statement from BDEW, which represents Germany's main gas and electricity suppliers. They say that Russia's demand for ruble payments raises the risk of supply outages here in Germany. So they've asked the German government to basically issue a level 1 warning, and 1 is the lowest out of 3 different tiers, and that's part of Germany's natural gas emergency plan. Basically, what this would mean is that the energy regulator here would look at different industries and sectors and decide which will get priority for natural gas if we do face shortages. So to be very clear, we're talking about industrial energy rationing. That, of course, would have a clear negative impact on the economy if certain industries have to shut down or reduce production due to a lack of gas. But it's also important to note here that consumers and households would not be impacted by this rationing, according to the BDEW energy group. So that's certainly a relief to all of us here in Germany.
Chelsea Delaney, right there in Berlin. Thank you so much, Chelsea. All right, now moving on. The year of the squeeze is proving to be real, with rising cost of living choking economies slowly. Let's bring in Juliana right now from the UK to bring us up to speed on what's happening there. Great to have you, Juliana. Well, UK consumer confidence has plummeted for 4th month in a row as the Ukraine war, surging cost of living, and the pandemic leave people are facing a wall of worry. Juliana, this was quite expected.
It was quite expected, Laddie, and it also comes, this survey result by GfK, which is a market intelligence firm. Their surveys are closely watched by economists because I think it's widely believed that they get a broad spectrum of the UK economy. So they've released their survey showing that consumer confidence is at a 16-month low in this country. Going back, you've got to go back to November 20. Is it 2020? Yes, November 2020, when this country entered into a second lockdown because of COVID cases. That's just how bad people are feeling now. And then we've got this data from the British Retail Consortium showing that retail sales have fallen in February by 0.4%. This follows a rise by 1.9% in January. So it does show that the cost of living crisis is really affecting consumers up and down the country. According to GfK, it's the big ticket items that people are second guessing themselves over. So we're talking about big electrical goods like televisions and the white goods that go into your kitchen, cars, and of course clothes. And it is affecting people when they go to the shops, because now you will see that prices are rising rapidly. We're not talking about a 1 pence, 2 pence. We're talking about £1, 50p, in some cases a 70% rise in goods. It is all linked to inflation. Inflation is up 6.2%, supply chain issues, and then of course the war in Ukraine by Russia. That has caused oil to go up. People are feeling it at the petrol pumps, and that's why we had that pretty stark statement from the Resolution Foundation think tank yesterday, suggesting that 1.3 million people in this country will be plunged into poverty because of where we're heading. Inflation is at 6.2% now, Laddie, but there are some suggestions it could reach 9%. Some people are even saying double digits, and this comes at a time where wage growth is slowing. Consumer confidence is very low, and in a couple of weeks' time, our bills in this country are going to rise by 50%.
Quite scary projections there. All right, let's the P&O ferries back in the news again. Transport Secretary Grant Shapps has said the boss of P&O ferries should quit for his brazen, breathtaking arrogance in admitting breaking the law of a mass sacking. Quite an interesting turn of events there.
Yes, it is. Yesterday, Peter Hebblethwaite, he is the Chief Executive Officer of P&O Ferries. He was hauled in front of a group of cross-select committee MPs, and it was pretty shocking. A bit of TV, actually, if you watched it. Yes, he did say that P&O Ferries broke the law. They broke the law because when they decided to immediately sack 800 seafarers, they were given no notice. And he says to compensate the fact that they were given no notice, to compensate the fact that they broke the law, they are going to be giving people a pretty nice payout, nice for some, not so nice for others, between £45,000 to over £100,000. Most of the individuals that were working for P&O Ferries were on just above about £8.50 an hour, which is the national minimum wage for anybody over 23 in this country. We are hearing suggestions that perhaps some of the new foreign Indian workers that will be on the P&O Ferries could be earning as little as £2 per hour, which is obviously not enough to be able to have a decent living standard in this country. Grant Shapps, the Transport Secretary, is pretty peeved off with some of the comments, brazen comments as he calls them, made by the CEO yesterday, particularly when he's on over £350,000 a year without taking away some of the bonuses that he receives. And he thinks that he was very cocky and brazen. Labour, the opposition party, tried to push in a motion earlier this week to stop this firing and rehiring technique that a lot of brazen companies are trying to do in this country. But that didn't go through. However, there are going to be some new laws put in place, and they are going to try and get P&O Ferries to rehire some of these staff. Whether or not they would want to go back is a question. Whether or not some would want to take that pretty chunky payout is another. But yes, if you do get a chance to watch that select committee hearing yesterday, it's pretty worth the while, laddie.
Yeah, quite interesting. We'll keep tracking that story. But how are the markets, digesting, data coming out in the UK?
Well, the FTSE is in positive territory today. Most notably, I presume it's because investors are a little bit cheered because of the presence of President Joe Biden in Europe. He's just flown off to Poland. That extraordinary NATO meeting yesterday did show that the West and its allies are doing whatever they can to try and stop this brutal attack on Ukraine by Russia. Bit of local continental African news. It was Airtel Africa. Their shares have plunged 10% today, really dragging down the FTSE All-Share because of Singapore Telecom. Now, Singapore Telecom this morning decided to sell 60 million shares. So this is a huge story in London, even though it's an West African story. There could be some severe ramifications for the firm, but that wasn't enough to drag down the FTSE into negative territory. The all-share is up 0.14% at intraday. The FTSE 100 is up 0.15%, and the FTSE 250 is up 0.47%. In the currencies market, the British pound is currently trading down on the US dollar by 0.02%, also down on the euro by 0.16%, and down on the Japanese yen at intraday by 0.62%, laddie.
All right, I'll be watching that stock, see how it closes on the NGX. Thank you so much, Julian. Always great to talk to you. Enjoy the weekend.
Thank you.
All right, now let's take a look at what's happening in Asia. We see Chinese stocks fell as the rest of Asia Pacific traded mixed, while Wall Street stocks rallied overnight and all prices fell. Hong Kong's Hang Seng Index dropped 2.47% to close at 21,404 points, bearing some losses after plunging nearly 3% earlier. Shanghai Composite was down 1.17%, closed at 3,212 points, and the Shenzhen Component fell 1.89% to close at 12,072 points. Australia's S&P ASX 200 stayed in positive territory as it inched up 0.26% to 7,406 points, with some gains in minors. South Korean stocks struggled for direction, trading between gains and losses. The Kospi last sat above the flat line and settled at 2,729 points. All right, we'll take a break now. When we come back, more stories on the African continent. That's in a moment. Do stay with us. All right, let's get more markets. Now, U.S. stock futures were a little changed today after a bounce back session on Wall Street. Futures tied to the Dow Jones Industrial Average ticked down 27 points or 0.1%. The S&P 500 futures were up 0.1%, while the Nasdaq 100 futures added 0.20%. We have Maria Bird now giving us a rundown, a summary of the yesterday's trading.
The U.S. stock market rallied on Thursday, a major upswing from Wednesday, as the S&P 500 was up 1.4%. The Nasdaq was up 1.9%. Tech stocks truly performed on Thursday, and the Dow Jones was up 1%. Investors were more confident on Thursday after Wednesday, when inflation was a major concern. Investors are also looking forward to seeing what the Federal Reserve Bank will do in the coming weeks, as the Federal Reserve is expected to have 7 rate increases over the next year, which may stabilize the economy and actually end the volatility.
And now to our next conversation. Well, wild swings in asset prices following Russia's invasion of Ukraine are prompting some investors to pair risk in their portfolios, fearing that the type of volatility seen in commodities in recent weeks could hit other markets. Let's get a sense of investor sentiment in Africa with Terence Hove, senior financial analyst at XNES. Great to have you on the program.
Good afternoon, Laddie. Thank you very much for having me on the show.
Great to have you. Well, the global economy is quite rattled right now with geopolitical tension, rising global inflation. How do you see, investor sentiment in Africa right now?
That's a very good point that you've, pointed us into. I think the sentiment was picking up as I think coming from, the lockdowns that we had because of COVID. But now, since the global crisis, the geopolitical crisis that has ensued since the end of February, the sentiment generally has been dampened. However, what has also been quite interesting is that some of the bouncers of the continent, such as the JSE, have actually performed fairly well, over the past couple of weeks. So while the sentiment is a bit low, given the global backdrop and uncertainty around the future due to the geopolitics that's currently ensued, it's looking favorable to some extent, given the dampenness at the moment.
Right, and bond markets have, hit historic downturn, as central banks battle inflation. What's your outlook for, African bond markets? We've seen Ghana, Egypt, raise rates.
Yeah, so I think Africa is no exception to what's happening globally. The chief thing is inflation. And coming from last year, if you remember, towards the middle of last year, going to the end of last year, the word that was being used around inflation was transitory. Now, that proved not to be transitory. It proved to be persistent. And as such, central banks had to respond accordingly. For example, we saw yesterday with the South African Reserve Bank increasing interest rates by 25 basis points. And as you mentioned, Ghana and the Egyptian Central Bank also increased interest rates respectively. Now, this is to combat inflation, which is rampant now, also compounded by this geopolitical tension that we have, crisis that we have at the moment. So inflation is somewhat, in its peak, and all the African countries are no exception to what's happening in the world at the moment.
Quite interesting. But which asset class do you see, African investors shifting to in 2022?
I think equities are looking quite favorable at the moment. This, as I mentioned earlier on, if we look at the performance of the Johannesburg Stock Exchange, for example, which has actually picked up quite quite significantly over the past couple of weeks is testament of that shift of investors into equities. I think also compounded by them looking for returns. So probably you look at some of the, commodity exporting companies that are probably doing very well given the elevated commodity prices. So investors will be chasing that kind of return from their capital.
Quite interesting. Well, Terence Hove, Senior Financial Analyst, Exness, thank you so much for coming on the program.
Thank you very much, Laddie. Have a good day.
All right, now the fourth South African Investment Conference has been concluded at the Sandton Convention Center in Johannesburg. Goal is to raise at least 1.2 trillion rand in new investment over a period of 5 years, ending in 2023. The fourth investment conference managed to raise a further 332 billion rand in pledges from investors who vowed to support the economic recovery project. The new pledges add to a total of 774 billion rand in pledges by the time of the third investment conference. Our correspondent, Brian Figeni, reports.
Investors from different business sectors gathered for the fourth South African Investment Conference, willing to make their investment commitments. President Cyril Ramaphosa officially opened the conference and said the conference could not have come at a better time as the country is on the road to economic recovery from the COVID-19 pandemic.
We know that our challenges are huge, they're gigantic, they're also complex, and they're also protracted. But we are neither defined by these challenges, nor are we daunted by them. Rather, we are dedicated to surely, steadily, and decisively overcoming them.
The African Development Bank strongly supports South Africa's investment conference, from energy to infrastructure, the establishment of agro-industrial parks, to support to the private sector, small and medium-sized enterprises, to create jobs for the youth especially, as you had said, Mr. President. We will provide robust support. Your Excellency, Mr. President, I'm therefore delighted to announce that the African Development Bank will commit 42.5 billion rands, that's $2.8 billion, to South Africa over the next 5 years.
President Ramaphosa also highlighted that no economy can operate without a reliable energy supply. Eskom says they are working towards increasing capacity to attract investment.
We agree with the President. We know that we need to add additional capacity to the grid as soon as we can in order to ensure that electricity supply, or a lack thereof, is not a constraint on growth and job creation in the country. And that is why I'm representing Eskom here today at this investment conference, is to talk to investors, to tell them that we would like them to come to South Africa to participate in building this new generation capacity that can alleviate this constraint on growth.
Another issue raised has been attacks on foreign national businesses, with Operation Tutula at the forefront of the latest attacks, and how these attacks will affect foreign investors.
If there's violence, definitely it can be a stumbling block. That's why we want this matter to be properly regulated. And it must be done in such a way that we must accept that we also deliver goods and services into the other countries, into the continent. And part of this African Trade Agreement talks about free movement of people. But free movement of people does not suggest that we're not sovereign countries, there are no borders. The borders must be respected.
This is a symptom of the high poverty, inequality and unemployment. So what you have to address is the root cause. And the root cause is definitely the conversation or the reason why we gathered here today, the investment conference. Because through getting investment, you can get the economy growing. And through getting the economy growing, you can get people, being employed, as it were. But I absolutely agree that this would be a huge concern because no business wants to operate in an environment that doesn't provide social stability.
South Africa is close to reaching its 1.2 trillion rand investment target, and as President Cyril Ramaphosa said, the country is open to investors to operate in a safe operating environment. With business partners like the African Development Bank saying South Africa is bankable, more investors are likely to place their investments. From Johannesburg, South Africa, Brian Figeni, Channels Television News.
Quite impressive pledges there. Well, the South African Reserve Bank's Monetary Policy Committee has announced a 25 basis point increase on the repo rate, taking it to 4.25%. Latest increase also brings the prime lending rates of commercial banks up to 7.75%. And Ghanaian President Nana Akufo-Addo and his ministers have cut their salaries by 30% under measures to reduce spending as the country struggles with higher fuel costs from the Ukraine crisis and stalled progress on a new tax. The finance minister announced that the foreign travel by government appointees, except for critical missions and the purchase of imported vehicles, had been suspended with immediate effect. All right, thank you so much for watching. That's the program for the week. Do remember to join us next week for more updates in the world of business. I'm Ladi Williams. Thank you for watching. Enjoy the weekend.